It's no secret most traders struggle with trading market structure. But what if mastering it was simpler than you think? Did you know that 90% of traders lose money because they can't trade market structure correctly? Welcome to Traders Endgame. In this video, I will show you 4 easy steps to trade like a pro using Lawrence's market structure strategy. By the end, you will spot high probability trades with confidence. No more guessing, just winning. If you are ready to stop guessing and start winning, hit that subscribe button. Let's dive in. In this first step, 1. We will understand market structure in short-term trading. 2. We will understand the 2 types of regular market structure. 3. We will get to understand the 3 types of Lawrence market structure swings. 4. We get to understand how to spot short-term swings using Lawrence's hidden secret.
What if I told you that a simple tweak to your chart could reveal hidden trends and turn losing trades into winners? This video is packed with game-changing tips. If you missed any part, understanding the short-term market structure will be tough, so stay locked in. Let's take a look at understanding market structure in short-term. Imagine if you could look at a chart and spot high probability trades like a pro. Wouldn't that be amazing? Well, that's exactly what understanding market structure can do for you. Let's quickly break down market structure in a super simple way so you can make a smarter trading decision. So, what is market structure? Alright, let's keep it simple. Market structure is like a roadmap that shows us how price moves. It helps us see if the market is going up, down, or just moving sideways. When you get this, you will know when to enter or exit a trade without guessing. Simple explanation of trends. 1. The uptrend. This is when price makes higher highs and higher lows. Imagine climbing a staircase. Each step is higher than the last. In trading, this means buyers are in control. 2. The downtrend. This is the opposite. Here, price makes a lower highs and lower lows. Like walking down a hill, sellers are in charge in this case. 3. Consolidation. Sometimes price doesn't go up or down much. It just moves sideways. This is like being stuck in traffic waiting for the next move. Why does it matter? Understanding market structures helps you spot the best place to buy or sell, so you are not just guessing. It's like having a map that guides you how to spot high probability trades, making your trading way less stressful. Let's take a look at our 2 types of market structure. Alright, before we continue, let me ask you this. Have you ever looked at a price chart and wonder if the market's going to keep moving in the same direction or suddenly switch things up? Knowing the answer can totally change how you trade. That's why understanding market structure is so important. It helps you see the bigger picture and make smarter decisions. Now, let's quickly understand the 2 types of market structure. 1. Continuation structure. This is when price keeps moving in the same direction, like a train staying on its tracks in an uptrend. It means more buying, and in a downtrend, more selling. Look for price making a higher highs and higher lows if it's going up. But if it's going down, watch for lower highs and lower lows. The trick is to join the trend on pullback when the price dips a little before continuing. It's like getting on a train during a quick stop before it speeds off again. 2. Reversal structure. Now, this one is exciting. A reversal is when the market changes direction, like a car moving a U-turn. Spotting this earlier can mean catching a big move. How to spot this reversal? In an uptrend, look for the price to stop making higher highs and start making a lower highs instead. This is called bearish reversal. In a downtrend also, watch for the opposite, price making a higher lows instead of a lower ones. This is called a bullish reversal. Think of it like a basketball. When it bounces lower each time, it loses strength and might change direction. This is called a bearish reversal. So, understanding these 2 types of market structure helps you trade with less guessing and more confidence. You will know when to stay with the trend and when to prepare for a change. So keep your eyes on the charts and practice spotting these moves. The more you do, the better you will get at finding those winning trades. If you are finding this helpful so far, don't forget to subscribe for more game-changing trading tips. Theory, the three types of Larry Williams market structure. I know you want to learn about the three types of Larry Williams market swings. Now, before we move on, the part where you will want to pay the most attention is understanding these swings. They are the secret to knowing when to enter and exit trade. Whether you like a quick move or a longer term plays, once you get this, you will be able to trade with more confidence and less guessing. By the way, in my previous video, I talk about price action mastering the Larry Williams highs and lows strategy like a pro. If you missed it, go and check it out. It's right at the corner of the screen. That video will help you understand value swings highs and lows a lot better. But for now, let's quickly take a look at the three types of Larry Williams market swings. 1. The short-term swings. These are perfect for quick trades. Short-term swings are all about catching those small price moves that don't last long, like grabbing a snack instead of a full meal. When to use it? If you like getting in and out of trades fast, this is your go-to-go. You are to look for a small profit, but more often. The key tip, focus on the lower time frame, like the 5-minute or 15-minute charts. Spotting quick highs and lows here can help you jump in and out before the moves is over. 2. The intermediate term swings. Alright, now we are talking about capturing bigger moves, but without waiting forever. These swings last a bit longer and give you a chance to grab a larger profit while still keeping things short term. When to use? If you want more than just a quick snack, maybe like a full lunch, intermediate term swings are for you. Key tip, look for the 1 hour, 4 hour chart. This is where you will spot those clean swings that can bring you a bigger wins without having to hold your breath too long. Theory, the long-term swings. This one's for traders who want to see the bigger picture and catch those huge moves. Long-term swings helps you understand the overall trend direction of the market. It's like planning a road trip instead of just quick drive. When to use? If you're okay with holding trades longer to catch the big fish, this is the move for you. Key tip, check out the daily or the weekly chart for this. Spotting higher highs and higher lows here can help you stay in winning trades way longer. Why it matter? Knowing which types of swing to use helps you trade smarter, not harder. You can pick the right moves based on how fast or how patient you want to be. And here is the truth, I won't shy away from telling you. Larry Williams taught that we have short-term swings, intermediate-term swings, and long-term swings on all time frame, from the 1-minute chart all the way up to the monthly chart. So no matter what time frame you trade, these swings are always at play. 4. Spotting short-term swings using Larry Williams' hidden secret. Listen up. Most traders miss out on the best moves because they don't know how to spot short-term swings the right way. But what if I told you there is a simple trick that can help you catch these moves with confidence every single time? Master the secret, you start trading like the pro. No more guessing, just smart trade. Let's take a look at how we can spot short-term swings. The hidden secret is 10 EMA and 20 EMA. The trick to finding meaningful short-term swings is knowing how to use the 20 EMA exponential moving average and the 10 EMA together. On the higher time frame, the 10 EMA and the 20 EMA help you understand the bigger picture, but for lower time frames, they are perfect for catching those quick moves. When we use these EMAs to mark our short-term structure, it helps us spot trends and reversal more easily. Think of the 10 EMA as the moving skirt and the 20 EMA as the leader. When the skirt moves ahead or fall behind, it signals for action. Let's see the trading strategy in action with our bullish and bearish setup.
So let's take a look at our bullish setup, spotting short-term upswings. Alright, if you have been struggling to catch the right bullish moves, listen up. There are 3 powerful secrets that can change the way you trade forever. Master this and you will spot short-term upswings with confidence. No more guessing, just smart, profitable trades. Let's break down the 3 EMA secrets to the bullish setup. 1. The secret of the EMAs. When the 10 EMA is above the 20 EMA, it's a sign that the trend is bullish. This means buyers are in control and pushing the price higher. The 2. Marking short-term swings. We use these EMAs to mark our short-term swings, helping us spot if the trend is bullish and what type of short-term swings we are in. Theory: strong upward momentum. The 10 EMA leading above the 20 EMA shows strong upward momentum, making it a good time to look for bullish trades. Alright, let's look at our bearish setup, spotting short-term downswings. Now, just as there is a secret to catching bullish moves, there is also a way to spot when the market's about to drop. Master this setup, you will know exactly when to go short, turning those downswings into profit. Let's quickly break down the 3 secrets to the bearish setup. 1. The secret of the EMAs. When the 10 EMA is below the 20 EMA, it's a sign that the trend is bearish. This means sellers are in control and driving the price lower. 2. Marking short-term swings. We use these EMAs to mark our short-term swings, helping us spot if the trend is bearish and what type of short-term swings we are in. Theory: strong downward momentum. The 10 EMA leading below the 20 EMA shows strong downward momentum, making it a good time to look for bearish trades. Alright, let's jump into some real example on the 1 hour chart. I could have used the daily chart, but I want to make sure you understand how to spot complex market structure without getting confused. If you remember, I talked about the 2 types of regular market structure and the 3 types of Larry Williams market structure. Well, here is the secret. Those 2 regular market structure are what Larry Williams called TC, trend change, and BC, breakout continuation. This is big because once you know how to spot TC and BC, you will know exactly when the market's about to shift or keep going. So get ready to see how this works on the 1 hour chart, because if you can spot it here, you can spot it anywhere. So if you are enjoying this video, hit that subscribe button so you never miss out on the powerful intermediate term strategy. Alright, we have come to our final examples, the one we all have been waiting for. Let's break down the January 2025 chart step by step, starting with adding your EMAs and spotting those key trend changes. First, open trading view. Click on the indicator at the top bar, search for EMA and add it to your chart. Set the length to 10 EMA. Go to style to increase the thickness and change the color for better visibility. Repeat the same step to add the 20 EMA. Once you are done, your chart is ready. On January 1st, Euro USD was bearish. The 10 EMA was below the 20 EMA. Price pulled back to the 20 EMA, creating a short-term swing high, then broke below, a move known as Larry Williams breakout continuation. We see a swing high bearish, but the 10 EMA crossed above the 20 EMA. Remember, until price take out the swing high, the main trend is still bearish. This shows that minor structure is fighting against the major swing high structure. On the chart, we spot the short-term swing high being broken. This is what Larry Williams called the trend change, a sign that trend might be shifting. After price take out the swing high, the next step is to find the swing low. To do that, look for short-term swings after the breakout. So, I don't want to waste your time. Let me quickly mark the swings from January 1st to February on the Euro USD chart. I will show you exactly how the market structure played out once I am done. If we turn off the EMAs, we can still see that market structure was marked correctly. Here is the truth. Minor structure often fight against the major swings. To deal with short-term swings, I will introduce you the Larry Williams most powerful intermediate term swings, but more on that in my next video. Stick out. Alright, let's quickly recap what we covered. 1. Understanding market structure. We talk about uptrends, downtrends, consolidation, like a roadmap for price movement. 2. The 2 types of market structure. We talk about continuation keeps the trend going, while reversal signal a change in direction. 3. Larry Williams 3 types of market swings. We talk about the short term for quick trades, the intermediate term for bigger moves, and long term for catching the overall direction. 4. The secret of the EMAs. Using the 10 EMA and the 20 EMA to spot trends and short term swings effectively. Finally, if you have learned something valuable today, like and subscribe for more pro level trading strategies. Thanks for watching. Happy trading. God bless.